Hi, this is Dan Smith of DPS Legal Counsel, and welcome to today's video and podcast episode of Einstein's Theory of Taxability, where I talk about tax issues of interest to businesses and individuals who are interested in tax things. So today I want to just do a little potpourri episode and talk about a couple of things dealing with the federal estate tax. It's been about, hard to believe, but it's been about 12 years since the entertainer Michael Jackson passed away. And after Michael Jackson died, since his death, there has been a huge tax court case that's been simmering and out there dealing with how much estate tax Michael Jackson's estate owes. So just to give you a little, and it's interesting for people who are interested in tax matters, and it's also interesting just for people who know and are interested in Michael Jackson and what's happened to his estate. So let me give you a little bit about what happened. This past week, the tax court issued an opinion addressing Michael Jackson's federal estate tax audit. So what happened was, after Michael Jackson died, and after his estate prepared and filed the federal estate tax return, the Internal Revenue Service audited the return, as you might imagine, and there was a big difference between what the estate claimed was owed on his estate tax return and what the IRS claimed should be paid on his estate tax return. Now, without going into all the details, let me just point out one asset in his estate over which there was a huge disagreement. Now, on Michael Jackson's estate tax return, the estate claimed that the value of the asset attributable to his likeness was worth $2,105. Now, this was based on a valuation, an appraisal done by a very well-known valuation company. And the reason it was so low was because at the time of Michael Jackson's death, it had been several years since he had been able to generate any income from his actual likeness because of the legal problems he was having, which are well known now. And based on the fact that his reputation was not what it had once been and was negative, in fact, and the fact that he had not earned any money from his likeness for several years, the valuation company put the actual value of his likeness at $2,105. Now, the IRS, as you can imagine, disagreed with that valuation and said that his likeness was worth $434 million, a big difference between $2,105. In the tax court opinion that came out this week, Judge Holmes wrote the opinion for the tax court. He is my favorite tax court judge. His opinions are worth reading by anyone who's interested in tax law, and even people who aren't interested in tax law should read his opinions. They are awesome. Judge Holmes referred to the amount that was put on the estate tax return for the value of Michael Jackson's likeness and image being $2,105 as essentially the value of a 20-year-old Honda Civic. Okay, so that's a very interesting thing for him to say, and it's kind of funny. There's some other things in the opinion that are also great. He quotes Petrarch, the Roman philosopher. He quotes Ernest Hemingway. There are all kinds of wonderful allusions and quotes in this opinion, and lots of humor. But getting back to the case, like I said, when the return was filed, it was the value on Michael Jackson's likeness and image was put at $2,105. The IRS claimed $434 million for that asset as the value. when it got to trial, the estate got a new appraisal using a different methodology for valuing Michael Jackson's likeness and image, and came up with a revised valuation of somewhere over $3 million. And the Internal Revenue Service also got an expert to do a valuation, and they essentially reduced their initial claim, which they had in their notice of proposed deficiency, from $434 million to just $161 million. So they did reduce it considerably, but it was still a big gap between the estate saying it's worth $3 million and the IRS saying it's worth $161 million. Well, Judge Holmes essentially agreed with the valuation methodology pretty much down the line with the expert and the valuation done by the estate. And so he did his own numbers and discounting and some other calculations, so instead of it being around $3 million, he came in in the opinion, around $4 million. Still a big difference from what the IRS was claiming, $161 million, and way less than what they had put in their initial proposed deficiency of $434 million just for that one asset. So a couple of things about this case. First of all, this Michael Jackson case, state case, shows a couple of things that people need to remember. One is if you are going to be filing a return in which valuation is a big issue, you need to make sure you get a good valuation done, a good appraisal done by a very by a very well-known or a very competent and experienced valuation company. In this case, that Judge Holmes was complimentary of both the state's valuation company that was done as part of the trial, the $3 million valuation. He was also complimentary of the valuation company that did the initial valuation for the estate tax return, which produced a value of only $2,105. And in fact, the IRS had claimed that because the valuation was so far off from what the true value was, that the estate should have to pay a significant penalty because of that undervaluation. And Judge Holmes said no, that wasn't the case in this instance because it was a legitimate valuation and the estate had a reasonable right to rely upon that valuation of $2,105. And so again, that just shows that if you're going to be filing something with the IRS or taking a position on a tax matter in which valuation is important, it's always key to get a good, competent, strong valuation to support your position. That's number one. Number two, another lesson that comes from this case is don't freak out if you get a big tax bill from the IRS, because you can see they got a big tax bill on the estate of Michael Jackson just for this one asset. The valuation and what they were saying was owed in taxes was humongous, because they were valuing this asset at $434 million just on the initial proposed deficiency. As it turns out, that the court said that asset, instead of $434 million in value, was really about $4 million in value. So that's lesson number two. Don't freak out and don't take what the IRS says as gospel. You need to do your own diligence, get your own experts, and don't be afraid to take a contrary position to the IRS, as long as you can do so with reasonable experts and take your reasonable position in hand. You don't need to just fall over if you get a big number coming to you from the IRS. As was the case here, their numbers were way off, and it's a good thing that the estate didn't just say, okay, you're right, we're going to pay this big tax you say we owe. Those are the two big lessons I would say. Get your valuations, get a good valuation, and don't fall over. If the IRS takes a contrary position, they could be wrong, and you need to be courageous enough to stand up for your position if it's reasonable, and not be afraid to go to court with the IRS. Now, another thing is, since this is Potpourri Day on estate taxes, I wanted to point out that the new Biden plan for taxes, the American Families Plan, contains a big change, if it were to go through, to how taxes come about after someone dies. This is not really an estate tax change, but it's a change that will impact beneficiaries of estates. For a long time, the statute has provided, the applicable statutes have provided that property that is owned by someone who dies gets a step up in basis to the date of death value. And so what happens is, if you have appreciated property owned by an estate, let's say land that was bought, or real property that was bought a long time ago and has gone way up in value since the time that the person who died bought it, what happens is, when that property passes to their heirs, the heirs can then sell it and not have a capital gains, because that property gets a step up in basis. So that if, for example, if someone bought a piece of property 20 years ago for $100,000 and now it's worth $1 million, the heirs can take it and sell it immediately after death for $1 million and have a zero gain. Whereas if the property did not get that step up in basis, and the basis remained the same in that property, it would still have the $100,000 basis, and if you sold it for $1 million, you'd have $900,000 in gain. So the step up in basis is very helpful, very protective of beneficiaries of estates. It's not a estate tax provision, it's an income tax provision, but it applies to protect beneficiaries who get property from an estate that has appreciated in value over time. What the Biden proposal is for the American Families Plan is to do away with the step up in basis, so that if you had property that passed through an estate, it would retain its original basis. And so if there was a sale of that property, there would be a huge capital gain. And in fact, the way I understand this proposal at the present time, and it's not, I don't think there's any statutory or proposed statutory language yet. It's just a proposal, but it's my understanding that they're not even going to wait, if it did pass into law, not going to even wait for there to be a sale, but have that capital gains imposed at the time of death. And if that's the case, if that were to go into law, you would end up having, for states, almost always having to sell property that it might not want to sell, just to get enough money in to pay the capital gains tax. So hopefully this provision will not pass into law. It would be a real bad thing for beneficiaries and for our economy, which has always taken into account this step up in basis. It would really, really be a major change in the law. If you want to read an article about this proposal, about the President's proposal to do away with the step up in basis, there was an article in this most recent Saturday's edition of the Wall Street Journal that talks about it. That would have been on May the 1st. May the 1st, Wall Street Journal had an article about the proposal of the Biden administration to do away with the step up in basis. So take a look at that. We'll need to keep following that as this proposal gets fleshed out, and there will obviously be a lot of pushback. I kind of doubt this provision will ever go into law, but it is a proposal at this point by the Biden administration to do away with the step up in basis. So that's it for today. I just want to talk a little bit about Michael Jackson's estate case, okay, and I also want to talk about this proposal to do away with the step up in basis, just to kind of keep you up to date about some of the big goings on in tax world. So until next time, when we do another episode of Einstein's Theory of Taxability, we'll see you then. And until then, if you have any questions about tax issues or anything else like that, please feel free to reach out. Thanks.